Hello, everyone. Good afternoon, and welcome to our live webinar event. We're extremely excited to have you here with us today, and we're going to get started in just a moment. So thank you again for joining us today. We're going to be covering discovering which account is right for you. And we're going to be going through the most popular investment account types available at Questrade and covering the kind of tips and tricks that you might need to help get started and pick which one might work best for you. So at Questrade, we care about Canadians' financial success. We offer better, simple, more affordable ways to take control of your money. And a quick disclaimer before we kick things off. So the information in today's webinar is for informational, educational purposes only and should not be taken as any form of investment, financial, or tax advice. I'm not your financial advisor and I'm not your accountant. So you're fully responsible for any investment decisions you make and any profit or losses that may result. So please keep that in mind. Today's session is for information and educational purposes only. And the quick introduction for myself. Pleasure to meet you all. My name's Jonathan. I'm the Educational Content Supervisor here at Questrade. Been here about 5.5 years, and I'm extremely passionate about investor education. I help Canadians understand the basics they might need to help get started and cover even the advanced topics that you might need to succeed. So whether it's TFSAs or RRSPs, stocks, ETFs, covered calls, options, and dividends, I'm here to help and here to answer all your questions today. So let's jump into our agenda. So what are we going to cover in today's session? We're going to kick things off with why I should start investing, probably the most important million-dollar question before we even go through the different types of accounts. Then we'll cover the top 3 registered accounts, TFSAs, RRSPs, and the brand new First Home Savings Account, or FHSA. We'll cover some important tips, watch-outs, tax tips, and some pros and cons for all these accounts as well. Next, we'll go through non-registered margin accounts. If you've maybe exceeded your contribution room, if you've maxed out your contribution room, or if you're looking for some of the advanced features and benefits of a margin account. Next, we'll go through a few more registered accounts that are worth mentioning, like the RESP, locked-in retirement accounts, retirement income funds, and things like that. And we'll wrap up with a live Q&A at the end of today's session around the 12:45 mark. So why should I start investing? It's pretty straightforward, but we're going to cover a couple of maybe more complicated concepts. And here, the first one being the value of money over time. Put simply, the value of money refers to inflation and the value of your dollar being able to achieve less. So over time, if you guys take a look at the chart on the right-hand side, you can see how the price of a cup of coffee has changed over the last 20, 30 years. So back in the 70s, you could get a coffee for a quarter. You could probably get a mortgage for a lot less than today as well. So this effect of inflation, essentially what it means is your dollar is worth less year over year. In the last year, for example, it was about 6-7%. So compared to this time last summer, your dollar is worth 6 or 7% less. Now, how do we fight this? We fight this with investing and saving over time. So investing can help you fight the effects of inflation more than simply saving. And that's going to give you the financial ammunition you need, so to speak, to tackle your goals, no matter if it's retirement or buying a home. And we're also going to go over compound interest really quickly. I'm sure you guys might have heard this term, maybe in your finance courses way back when in school, and it's not that complicated. You can think of compound interest like a snowball rolling down a hill. We're here in Canada, so this analogy hopefully makes sense to everyone. A small snowball starts at the top, and as it goes down the hill, it's going to pick up more and more snow and more speed. You can think about your investments this way as well. Even if you start with a small amount when you're young, over the long term, and by staying consistent and staying patient, you can grow that investment over time with compound interest. Essentially, what it is as your investments earn capital gains or dividends, those are then reinvested, causing that snowball to grow over time. So you can see on this chart here, if simply saving versus investing. If I save for 10 years, $400 a month, I'm probably not getting a huge amount of interest in my savings account. So I'm probably going to end up with about $48,000, $50,000 over 10 years. Not bad, but not great either. Now, if I put that money to work and invest that $400, over 10 years, I could end up with almost, maybe not twice, but at least $80,000. Now, this is based on the historical performance of the S&P 500 over the last 72 years on average. So every 10-year historical period is going to be a little bit different. Now, what about retirement? How do I become a millionaire by the time I retire? So if you take a look at this chart here, it kind of shows the power of consistency and increasing the amount you save over time. You start with only $200 a month at 20 years old and build that up as you age. You could easily achieve a portfolio of $1 million plus by the time you're 60. Now, how much that million is going to achieve in 20, 30 years, we're not sure. Nobody knows where inflation is going to go. But investing is your best kind of hedge against inflation or best insurance. Now, I mentioned this earlier, investing expectations versus reality. Investing is not going to be a perfect line chart going up over time. There are going to be some ups and downs. It's a bit of a roller coaster. And this will depend on what you invest in, how long you're invested in, and your risk tolerance. So there's some fancy words here that I'll explain. Time horizon being the first one, how long you're investing for. So everybody's time horizon is going to be a little bit different. If I'm buying a house at the end of this year, my investing time horizon is going to be very different than if I'm saving in my retirement or saving in my RSP for retirement. That's going to be in 30, 40 years. And then there's also your risk tolerance, how comfortable you are with taking on that investment risk, how comfortable you are with the peaks and valleys of the roller coaster over time. So what are you investing for? Investing can help you achieve a variety of different goals, whether it's buying a home, sending your kids to university, retiring on your terms, and much more. It's important to start when you're young, but it's never too late. Nobody's ever going to say saving and investing was a mistake. I should have waited to start. Luckily at Questrade, we offer Canadians two easy ways to invest. We've got our self-directed accounts where you can do it yourself, pick your own stocks, ETFs, and make your own portfolio. Or we have our pre-built portfolios through Questwealth Portfolios that are managed by experts on your behalf according to your risk tolerance. So no matter your preference, we do offer both, and you could even do both as well if you'd like. So while we're going through the different account types, if anybody in the audience is interested in setting up an account and getting started, please feel free to scan the QR code on your screen here, and that'll take you to either the iOS App Store or the Google Play Store to download our new Quest mobile app, where you can start opening an account and getting started with trading and investing. So let's jump right into things. What are registered accounts? Maybe you've heard this term, you've heard your friends talking about it, but what are they really? I'm going to introduce you to your three new best friends, for lack of a better term, the RRSP, TFSA, and the FHSA. So we'll cover them left to right. RRSP is a registered retirement savings plan, and the primary purpose of this account is to help Canadians save for retirement. There are a couple other ways you can withdraw, which I'll talk about in a little bit later on, but the main purpose of this account is so you can put money away, invest it, and save for retirement. The main benefit with an RRSP is as you make a contribution and a deposit, you reduce your total taxable income, which can help save on your tax bill, and your investments grow tax-free as well. Next, in the middle, we've got our tax-free savings account, or the TFSA. I really don't like the name of the tax-free savings account. I wish that the CRA would have called it the tax-free investment account, since it would maybe help explain what the account's for a little bit better to most people. When I talk to my friends and family, most of them think that your TFSA is for saving only. But that's a very common misconception, and you can actually invest in stocks, bonds, ETFs, and much more inside of your TFSA as well. The main benefit with the TFSA is that contributions and withdrawals are both tax-free. So although you're not getting a credit or reducing your income when you make a deposit, when you take that money out, you don't have to worry about paying any taxes either. And most investments also grow tax-free. There is only one type of investment that's a US dividend that is considered taxable in a TFSA, which I can explain a little later on. And then last but definitely not least, we've got our FHSA, or the tax-free first home savings account. This account was launched back in April 1st of this year, so it's our first registered account in almost 15 years or more. And the primary purpose of this account is to help Canadians save for their first home, whether you're buying or building. It works kind of like if an RSP and a TFSA had a kid, where you get the best of both worlds. As you make a contribution into your FHSA, you claim that on your income, so it reduces your taxes. And if you're using it for a qualifying withdrawal for your first home, you also don't pay any taxes on the withdrawal. So it's like having the best of both worlds. We'll cover this in a little bit more info later on. So what are some of the benefits of using a registered account? Like I mentioned earlier, qualified investments grow tax-free. So you're never going to have to worry about any sort of capital gains tax. You can buy low and sell high as many times as you want. That being said, the tax-free savings account is not a day trading account. And some accounts like the RSP or the FHSA can also help you reduce your total taxable income, which we'll cover in a little bit. And then some of these accounts also offer flexibility with your withdrawals. So we'll go through the first one. Registered retirement savings plans. That's a mouthful, so we're just going to call them RSPs from now on. And let's get into the nitty-gritty. So how does an RSP work? You can contribute up to 18% of your income per year. So for this year, the government has stated the maximum is $30,780 for the 2023 tax year. And this changes every year as well. It's gone up and it's indexed to inflation. So next year, we'll probably see still going to be 18% of your income, but it'll probably go up to around $31,000. And you can get these numbers from the CRA if you need. The good news is if you haven't contributed, that unused contribution room carries forward. So I'll use myself as an example. I'm not able to max out my RSPs every year. So I've got a little bit of extra room that keeps getting carried forward. Eventually, if I have a lump sum that I'd like to put in, I can take advantage of that unused contribution room. The main benefit with an RSP, like I mentioned earlier, is as you make a deposit, that reduces your income. So hypothetically, if my yearly income is, let's say, $60,000 a year, and I make let's say $10,000 contribution to my RSP, in the eyes of the CRA, my income has now gone down to $50,000. So I will be able to claim that $10,000 and get a pretty healthy tax refund depending on my entire tax situation. And one of the other benefits too is if you're not using the funds for retirement, you can also do a special withdrawal through the home buyers plan or the lifelong learning plan if you're either buying a home or going back to university. However, these two special withdrawals do need to be paid back into the account. So how does it work? So when you make your contribution, this reduces your total taxable income. You can see our friend here on the left makes a deposit into the RSP in the middle, and he's going to get that tax refund at the end of the year if his income and all the other factors line up. Now, if you're using this to buy a home or go back to school, you do have to pay that withdrawal back. However, if you wait until you retire and you're taking money out of your RSP, that's the ideal scenario. The ideal scenario is you're retired, you're not working, you don't have a huge amount of income on paper, and you're able to take those withdrawals out of your RSP in a lower tax bracket. So saving for your future is also helping you save right now. So what are some of the pros and cons? We'll go through some of the pros first, and then maybe some of the cons on why you wouldn't want to consider an RSP account. The main one's going to be that tax deduction. Everybody loves saving money on their taxes, and I don't know about you guys, but I love when I get that refund from the CRA instead of owing at the end of the year. The other one's investments grow tax-free. Why would I pay capital gains tax if I have the RSP or another room available? It's a no-brainer. If you don't have to pay the tax, don't pay it. Your investments grow tax-free in an RSP. And the main point, all dividends are also tax-free. Doesn't matter if they're Canadian or US, the RSP is fully tax sheltered. And then you've also got the home buyers plan and the lifelong learning plan. So it does offer some level of flexibility. If you've got a large amount of funds in your RSP, for example, you didn't have a first home savings account because it didn't exist until this year, it may make sense to take advantage of that home buyers plan. And then some of the cons. So why wouldn't you want to consider that RSP? The main one's going to be most of those withdrawals are taxed. So if you anticipate that you're going to be in a high tax bracket when you retire, maybe you're going to keep working, maybe you run a few companies or own some investment properties, that withdrawal out of your RSP during retirement may be taxed at a higher rate than when you put it in. So that's something very important to consider with your RSP, is how much money you're going to be making during your retirement years. The other con is limited contribution room. I know 30,000 seems like a lot, but for some people that might not be enough. They might want to deposit more. So the RSP, once they max it out, they may be looking for a second or third account. And then the last con is required withdrawals. So when you reach 71 with an RSP, you're required to convert it into something called a RIF account or a retirement income fund and start making minimum withdrawals each year as set out by the CRA. So like I mentioned earlier, if your income is high during those retirement years, these minimum withdrawals might increase the amount of taxes you pay. So just keep that in mind with an RSP, pros, cons. It isn't for absolutely everybody, but it is a great account for a lot of people who are saving for retirement. So ultimately, is the RSP right for you? And the answer is it depends. It depends on your financial goals, your income now, your income during your retirement years, your overall tax situation, whether you're single, married, have kids. A lot of other factors go into this. And it's never a bad idea to chat with your accountant or a tax planner, especially if you are reaching that retirement age and potentially having big tax consequences. So that's about it for the RSP. If you guys do have questions, feel free to drop them into our Q&A. I've got my colleagues answering them there, and we'll pick some of the best ones for the end of the session as well. Now, moving on to TFSAs. So like I mentioned earlier, I don't like the name. It's more than a savings account. I wish it was called the TFIA, but that probably confused a lot of people. So the TFSA is more than just a simple savings account. It can do a lot more. You can use it to invest in stocks, ETFs, GICs, mutual funds, bonds, whatever your heart really desires. And all capital gains are tax-free. So it doesn't matter if it's a Canadian or a US capital gain, those are always tax-free in a TFSA, and Canadian dividends are also tax-free. The only thing that's ever taxable in a TFSA is US sourced dividends or internationally sourced dividends. Usually those are taxed at a withholding rate of about 15%, but it does vary depending on which country it's coming from. So how does a TFSA actually work? So you earn contribution room for every year you're a Canadian resident over the age of 18. This is really important. Canadian resident and over the age of 18. I know I've run into a few situations with friends and family who maybe have recently moved to Canada. They've just become a resident and they incorrectly assume that they have more contribution room because they're counting the years when maybe they were on a student visa or something like that. So TFSA contribution room starts when you're 18 and you're a Canadian resident, and it accumulates. It keeps adding up if you haven't used it. It does carry forward, and I'll show you guys a neat table on the next page as well that kind of adds everything up. So while you can't claim your contributions against your income like an RSP, all withdrawals are tax-free. So the TFSA is a lot simpler than the RRSP. You don't have any taxable consequences you have to worry about when you put your money in or take it out. The only thing to keep in mind is when you do make a withdrawal from your TFSA, you don't get that contribution room back until next year. So let's say right now, hypothetically, my TFSA is maxed and I want to take $5,000 out for a vacation. I can't redeposit that $5,000 until next January when it resets. So January 1st is when your contribution room will reset from the previous year. So here's that table I was mentioning earlier. So I've kind of reversed this a little bit, where instead of the year, I've got your birth year when you were born on the left, and then your total contribution room. So if you're born in 91 or earlier, and you've been a Canadian resident the whole time and never contributed to your TFSA, you theoretically have a maximum contribution room of $88,000. I don't know about you guys, but that's a whole lot of room to take advantage of for tax-free growth for investing. Now, where can I check this? Let's say I've made some contributions. I'm not sure what my total contribution room is. The best place to check is on the My CRA website. So if you don't already have an account, I highly suggest everybody make an account with the CRA online. It's a lot easier than dealing with the paper mail. And you can actually log in and check your TFSA contribution room. One caveat there is most financial institutions like Questrade or the banks don't report your deposits until the end of the year when we're required to. So it might make sense to not just keep an eye on the CRA webpage, but keep an eye on your account activity and your own records. Now, what happens if I deposit too much? If I over-contribute, you will be potentially assessed a penalty by the CRA. Generally, if it's the first time and it's an accident, you take that money out right away, you can explain that to them. And sometimes they are willing to be a little bit more lenient. But if you're blatantly over-contributing, they've warned you in the past, they will assess a 1% penalty on any amount for every month that it's held in the TFSA. All right, so that's it about TFSAs. Fairly simple account type. My opinion, almost everybody should have one of these. If you qualify, it's a no-brainer. Now, what's the FHSA? What is this new tax-free first home savings account that just launched? So it's a new tax advantage registered account designed to help Canadians save for a down payment and any other expenses. So the good news with an FHSA, that qualifying withdrawal doesn't have conditions on what you spend the money on. So whether it's lawyer fees, you got an inspector coming, you got to redo your foundation or something like that, there's no limitations on what you use the money for, as long as it's a qualifying withdrawal, which I'll cover in a second. It combines kind of the power of the TFSA and the RSP for first-time homebuyers, and contributions are tax deductible. This is the best part. So when you put money into an FHSA, you claim it against your income, just like an RRSP. Now the contribution amount's a little bit lower. You can contribute up to $8,000 per year once it's opened. So if I open an FHSA today, I can deposit $8,000 for 2023. And next year, I'm going to get another $8,000 worth of contribution room, up to a lifetime maximum of $40,000. So you might be thinking, $40,000 doesn't sound like a whole lot. How's that going to help me with my down payment if houses are $1 million? Well, if you have $40,000, that's just your contribution. You can actually keep your FHSA open for up to 15 years, and that $40,000 can turn into a lot more over 15 years. So why do we need the FHSA? It's a pretty scary statistic here. The average price of a home in Canada is over $715,000. Now, I pulled this information back in April. It's probably about 20, 30 grand higher by now as well. And if we're looking at Vancouver, Toronto, average prices for all residential property types are well over $1 million. So the FHSA, even though it's some people call it a drop in the bucket, it is a fairly significant amount that you can still put towards that down payment that didn't exist before. So I'm quite happy that this account launched personally. Now, who's eligible? This is the big question. Not everybody will be able to take advantage of this new FHSA account. The main criteria are that you haven't lived in a home, that you or your partner/spouse have owned in this year or any of the last 4 years. So if my common law partner owns her own home, sorry, I can't open an FHSA. If I have my own property, I can't own an FHSA. Now, the main criteria here that the CRA has left a little unclear is that you have not lived in the home. It does not say you haven't owned the home. So hypothetically, you can own a home that you haven't lived in 5 years and still qualify for the FHSA. The other one is that you have to be a current tax resident of Canada between the ages of 18 and 71, and you have to be opening the account to save for a qualifying home in Canada. Now, one quick thing to keep in mind, which I'll cover in a sec, your eligibility criteria for opening the FHSA is not the exact same as for qualifying withdrawals. They're similar, but the criteria are a little bit different. And then how much contribution room do I get? So going back, we've got $8,000 of room that we earn each year, up to a lifetime maximum of $40,000. However, the FHSA is different than the TFSA in that you can only carry forward $8,000 total. So let's go back to my previous example. If I open my FHSA today and I max it out, I put $8,000 in, next year I'm going to earn $8,000 worth of room. Let's say next year in 2024, I'm not able to make a contribution. Maybe, I don't know, I've got big plans in life and I don't have the money to save. That means for 2025, I'm only carrying forward 8,000. I'm not getting 16,000 of room like I would with a TFSA. So just keep that in mind so you don't accidentally overcontribute. You can only carry forward 8,000 total in unused contribution room. And then last point, this might be obvious, but your FHSA contribution room is separate from your TFSA and RSP. Just because you've contributed to your TFSA and RSP doesn't mean that it affects your FHSA. They are completely separate programs and they don't have any implications for each other. Now, what can you actually invest in an FHSA? Stocks, ETFs, bonds, GICs, gold, options, and the list goes on. If it's a qualified investment, like most are, you can invest in it in an FHSA. And some of the pros and cons, like with the other accounts. So the biggest pro, you can contribute $8,000 a year and reduce your taxable income. I like the sound of that. Your investments also grow tax-free, and your qualifying withdrawals are tax-free. It's kind of a no-brainer. Your unused contribution room carries forward. And then my favorite point, if you don't buy a home, you can actually transfer your FHSA to your RSP with almost zero penalty. You're not paying any tax. You just lose the contribution room. And I can cover that in the Q&A if anyone has questions about that. The biggest con, withdrawals have requirements. You know, if you're not buying that first-time home, if you want to use the money for something completely unrelated, you unfortunately can't. You have to meet those qualifying withdrawal criteria. Non-qualifying withdrawals are also counted as income. So if you don't meet the criteria and you still need to pull that money out, that's going to be counted against your income. It's the main con. If you already own a home, the account may not be the right fit for you. I'm not going to outright say it isn't for you, but it might not be the one for you. And then how do qualifying withdrawals work? There's a whole lot of text on this page, but I'll try to break it down and explain it as simple as I can. So you must be a first-time home buyer. What does the CRA mean by first-time home buyer? This means you cannot have lived in a qualifying home as your principal place of residence that you owned or co-owned this year or any of the last 4 years, similar to when you're opening the account. However, there's a 30-day grace period right before the withdrawal where this rule doesn't apply. The reason the government put this grace period in is if you're using your FHSA to buy a home, things are busy when you're buying a house. You're talking to realtors, you're looking at properties, you're doing inspections, you're getting your mortgage. You might have forgotten your FHSA exists, or it might be the last thing in the back of your mind. You've got 30 days after you close on that property to still make that qualifying withdrawal. So just because you've bought a place, it doesn't mean it's too late. You've still got 30 days to qualify. One of the other rules, you must have written agreement to buy or build a qualifying home with the acquisition or the construction completion date before October 31st of the year after the withdrawal. So if, let's say, I'm buying a pre-construction condo, hypothetically, and it finishes next summer, I can use the withdrawal. I can make those series of payments as I need, and my withdrawal is completely tax-free. Going back to the 30-day grace period, you cannot have acquired the property more than 30 days before making the withdrawal, even 31. So please keep that window of time in mind. And then 1 or 2 more, you must maintain your Canadian residency from the date of your first withdrawal till the date of your acquisition of the home. And you must intend to live in the home as your principal residence for a minimum of 1 year. So This FHSA is not really intended for rental properties or anything like that, since you do have to live in the property. All right, hope that covers FHSAs for everyone. We are going to move on. Now, is the FHSA right for you? This really depends on your financial goals, your tax situation, your risk tolerance, and your eligibility. This may be the most important factor here. Do you actually qualify for the home? Are you going to qualify for that withdrawal in a couple of years or immediately? Big questions to ask before you open the account. Now, what's the difference between FHSAs, TFSAs, and RSPs? So the FHSA is not a replacement for a TFSA or an RSP, but a complementary add-on. So just because the FHSA allows you to take that money out tax-free doesn't mean you shouldn't open a TFSA or shouldn't open an RSP. These accounts have slightly different purposes and slightly different use cases as well. All right, so that's about it for registered accounts for now. We're going to jump into margin accounts or non-registered accounts. And thank you again for all the questions rolling it into the Q&A. I do see my colleagues answering them, and then I'll get to a few more as well in about 15 minutes. So what's a margin account and how does it work? So margin accounts are non-registered accounts, so they don't come with any special tax benefits or privileges, but you also don't have any limitations on how much you deposit and how much you trade, how often you withdraw. Basically, they don't have any limitations of any kind. Margin accounts also give you the option to leverage your investments or borrow to invest with more than you have available. So the max you can borrow theoretically in a margin account is 3-to-1. And we can cover that in a little bit more info, but I don't want to get too far into the weeds as well. But basically, using leverage or borrowing can help enhance your returns, but these are also going to magnify your losses. So borrowing to invest is a pretty advanced strategy and definitely not for everybody. So what else can a margin account do? Maybe you don't want to borrow money, but you want to do some other stuff. So why would you choose a margin account? First one's going to be your no contribution limits. If you've maxed out your TFSA, your RSP, you don't want to use the registered accounts because of some of the limitations there, a margin account's a great choice. So you can keep investing with that extra money. Another one is short selling. So let's say you want to short sell a stock or an ETF. This is basically borrowing a stock you don't own and selling it, and then you think the price is going to go down. This strategy is not available in registered accounts since it's prohibited by the CRA. So if you want to short sell a stock, you have to be doing it in a margin account. A few more kind of benefits. You've got a lot of trading flexibility, so you can trade anything in a margin account. One of the things you cannot trade in registered accounts is penny stocks. So these are OTC or pink sheets, as many people call them in the US. These are not available in TFSAs, RSPs, FHSAs, but in a margin account, you can trade whatever you want. That being said, penny stocks have their own risks that I would strongly recommend you research before jumping in. And that's about it for margin accounts. So they give you access to short selling, advanced option strategies, borrowing money, and much more. But if you don't want to take advantage of these, you can also treat it like a cash account. Just keep an eye on your balances and make sure you're not borrowing. So, like I said, you can use your margin account like a cash account. One of the main things to watch out for is, unlike registered accounts, your Canadian and US dollars are not converted automatically for you in a margin account. So if you want to avoid paying interest, it's important to keep an eye on your balances and make those currency conversions or trades as necessary. And kind of a quick warning as well, borrowing to trade can expose you to significant declines in the value of your investments. I'll use myself as a personal example. When I started trading 5-6 years ago, I started with a margin account. And I had a lot of very expensive lessons to learn in the market on why I shouldn't do X, Y, and Z. So just to keep those things in mind. If you're borrowing funds to invest, interest charges are automatic, margin requirements do change. And if your investments decrease in value, you do still have to pay back the borrowed funds. So it's not for everybody. And that's margin accounts in a nutshell. Now, are they right for you? That really depends on your financial goals, your tax situation, your risk tolerance, your own trading style, and your knowledge. Are you more of a day trader? Are you more of a buy and hold? And your comfort level with more advanced investing, especially if you're planning on borrowing. All right, now we're going to go into Questwealth Portfolios. I touched on these briefly at the beginning of the presentation, but we're going to do a little bit more of a deep dive on what they are and kind of how they work. So as opposed to self-directed investing, where you pick and choose your own stocks, ETFs, and bonds and build your own portfolio, Questwealth Portfolios, everything is basically done for you. They're intelligent, lower fee portfolios that are designed by experts that help you achieve your goals faster and cheaper compared to traditional investing with mutual funds at the bank. What we do with Questwealth is when you open an account, you answer a questionnaire that's about 10, 15 questions long that matches you up with a portfolio that meets your goals and needs. So if you're investing for a short time, long time, you don't want to take risk, you do want to take risk, there's portfolios for everybody, from conservative all the way to aggressive, including socially responsible options. Now, why? It's the ultra low fees, if I'm being honest. If we compare Questwealth portfolios versus the average mutual fund in Canada, you're paying about 1/10 of the fees. And that really, really makes a big difference over the 30, 40-year time frame. So why Questwealth Portfolios? It takes the emotion out of investing and automates your strategy for long-term consistency. I don't know about you guys, but I tend to get in a bit of a panic when I see headlines on the markets, when things are up and down, especially the last couple of years. It's been a volatile time. So Questwealth Portfolios can be a great answer to that if you're not comfortable managing your own portfolios, if you're not ready to keep an eye on the markets and constantly be rebalancing yourself. And it's also a great complement if you do self-directed investing. A lot of our customers like to have one account of each type, for example, myself included. Questwealth portfolios are also available as cash accounts if you've maxed out your registered accounts like your TFSA and RRSP. So there's no margin accounts in Questwealth, but there is a cash account. And we've got 10 different portfolios, all the way from conservative to aggressive, including socially responsible or green options, where we avoid investing in things that aren't considered socially responsible. And that's about it for Questwealth portfolios. I'm happy to answer any questions if they do come up a little bit later on. But before we jump into, or actually, let's jump into registered accounts, and then we'll do one more poll question. So other accounts worth mentioning. These three accounts, the RESP, the LIRA, and then the RIF, are another three registered accounts that are really popular amongst Canadians and Questrade customers. And I'll briefly cover kind of some of the benefits and pros cons of each here. We've got the RESP, which is the Registered Education Savings Plan. This account is fantastic if you're saving for your child's education, university, post-secondary. And you can also get extra government grants that basically give you free money in the account. The CESG grant, for example, gives you up to $500 in free money each year. And your investments also grow tax-free. So you're not having to pay a chunk of your gains back to the CRA when your kid goes to university. Then you've got the LIRA account, or the locked-in retirement savings account, very similar to a locked-in RSP. Sometimes people use the two terms LIRA, LRSP interchangeably. The main difference is LIRAs have a provincial pension legislation. Locked-in RSPs have a federal pension legislation. What these accounts are is when you work for a company that gives you a company-sponsored pension, or if you work for the government that has a pension, when you leave that job, you are given the option to take that account with you. You don't have to leave it at the finance firm that your company was using. So a lot of customers choose to move those over to Questrade, manage them themselves, or put them into Questwealth portfolios. They work very similarly to RSPs. The main difference is you can't make new deposits generally, only pension contributions, and there's additional restrictions on withdrawals. So another popular account type. And then last but not least, we've got your life or retirement income funds, your LIF and your RIF. This is what your RSP and your LIRA turn into when you turn 71. So when you reach retirement, you can roll it over earlier if you'd like, chat with an accountant and a tax planner, but you're required to do it when you turn 71. Your RSP goes from something you deposit money into to now being something you withdraw from, and you draw your income from, as like the name of the account suggests. And then minimum withdrawals are required, and some accounts that are locked in, like LIFs, may have maximum withdrawals. And that's about it for the last three registered accounts, and happy to answer more questions if we have them. So which account is right for me and my goals? Pretty tough question that I don't know if I can answer for you, but hopefully with the information given during today's presentation, we've given you guys the information and ammo you need. But I'll throw a couple of charts up to maybe help compare the two. So we've got registered accounts, margin accounts, and then the three most popular, TFSA, FHSA, and RSP. You can see there's a lot of similarities between them. Ultimately, it comes down to a few things like whether or not that deduction is, deductible, or whether or not that contribution is deductible on your taxes, whether or not you can make a tax-free withdrawal, how long you can keep the account open for. So there's different factors that go into choosing an account, and most likely it's going to be more than one that's going to suit your goals and needs. One account may not be for everybody. If you are interested in opening an account with us, you can start investing confidently with Questrade. It only takes about 5-10 minutes to set up an account online. You can use your phone or your computer, whatever is easier. Feel free to scan the QR code on the screen now to download the Quest mobile app, and you can get set up in minutes. Okay, wow. We got 28 questions already answered and 21 open, so I'll do my best in the next 15 minutes to get through everything. All right, I see a question about the RESP here at the bottom from an anonymous attendee. When can I start an RESP? So is there any restrictions on the child's age? Really great question, and it's a really straightforward answer. As soon as your child's born and you've got a SIN number for them, you can open the RESP. Some parents like to set up that SIN number right away, right when your child's born, but we get it. There's a lot of stuff to do when you've got that new baby coming into the household. So take a couple of weeks, get settled, apply for that SIN number and all the paperwork, then open the RESP. Not advice, but why wait until your child's 5-10 years old, especially if you're losing out on that government grant money. It's free money. So hopefully that helps answer. No restriction. You can start opening the RESP as soon as your child is born and they have a SIN number. And one quick caveat as well for the questions. Unfortunately, I won't be able to answer any very specific personal questions about your own financial situations, just because I can't give you guys personal advice, but happy to talk about things in a more of a general term. Here's another easy one. So how to reinvest cash in managed accounts. So we're talking about Questwealth Portfolios here specifically. So in a Questwealth portfolio, any cash that you deposit, any cash that you earn in the form of a dividend, let's say, that's all reinvested for you automatically. So if I have a Questwealth Portfolios RSP, for example, maybe I have some matching from my work or something, cash contribution that I make every 2 weeks will automatically be deposited. It's automatically going to be invested according to my asset allocations, and the cash is reinvested. So you get that snowball effect of compound interest fully automatically. All right, so I see a couple of questions about transferring accounts to Questrade, maybe for some new members in the audience. So here's a question from Carol. I've got a financial advisor with a RIF account and a TFSA account. Can I transfer these accounts without penalty to Questrade? Good news, the answer is yes. You can absolutely transfer any accounts over to Questrade that you'd like, and there are no penalties since it's moving to the same type of account. So if you move a TFSA, let's say at the bank, to a TFSA at Questrade, there's no taxable consequences since the money stays in that TFSA shelter, so to speak. That being said, most institutions will charge you a transfer out fee. This generally kind of varies between $75 and $150. But the good news is that Questrade will pay your transfer fees. So if you move an account to Questrade, whether that's an RRSP, TFSA, FHSA, we'll pay your transfer fees if the outgoing institution charges you any. All you have to do is set up the same accounts at Questrade first online. It takes about 20 minutes maybe to set up 2-3 different accounts. Once your accounts are approved and your documents are submitted, it's very easy to request a transfer from the other institution. And if you don't like your financial advisor, you don't want to talk to them, you don't even have to. You can fill out the transfer form online on Questrade's website, and we'll take care of the rest. One thing to keep in mind is that most registered account transfers do take about 2 to 3 weeks or more to process, since this processing time is on the other institution side, not at Questrade. We send the request, but some banks might take a month to move your accounts over to us. Hope that helps answer the transfer question and maybe some of the rebates about any fees you might be looking at too. All right, so got a few more. Good question about Questwealth Portfolios and the fees. So maybe for this one, let me actually go back a few slides. Just wanted to show you guys this little chart here at the very bottom. So in a Questwealth portfolio, there's actually technically 2 fees that are charged. The base 0.25%, this actually drops to 0.2% if you've got more than 100K, but we'll just say it's 0.25 for simplicity. That's what's charged by Questwealth. So that's the fee that we charge to manage your account for you. Let's say you start with $1,000, that's going to be $2.50 per year that you're paying for that management fee. The extra where you see that 0.37, so that 0.17, that is the MER or the management fees of the mutual funds themselves. So every fund, whether it's that's the management fee of the exchange traded funds themselves. Apologize for misspeaking there. So that's how Questwealth Portfolios achieve their lower fees, is by using ETFs or exchange traded funds instead of mutual funds. And those fees are disclosed fully for every single portfolio for a balanced portfolio. your total fees that you would pay is 0.37, and that includes the MERs and the Questwealth Portfolios fee. Hopefully that helps shed some more light there on that. Question about options. So maybe a little advanced, but we'll quickly cover it. Can I sell put options when I have enough money in my FHSA account? Great question. So selling a put option, if you have the backing, so to speak. So when we talk about options, there's options that are covered or hedged, and then there's options that are naked or not hedged. This might be getting a little complicated for a few members of the audience, but for those options traders, you cannot sell naked options in any registered accounts. However, if you're already short the position and it's just a hedged put that you're selling, that is available if you have level 2 options enabled. So hopefully that helps. I don't want to go too far down the rabbit hole there into options though. And question about the FHSA. If I buy a new house starting this year and construction ends next year, can I put the $8,000 in this year and $8,000 next year and then take out $16,000 next summer? It's a bit of a personal question, but we can talk about it in generalities. The answer is going to be yes. So as long as you haven't finished moving in and acquiring the home, you can still keep contributing and using that FHSA. So the deadline, that 30-day grace period that you got to watch out for, is around the acquisition or the construction completion date. Now, in this specific scenario, the only thing you'd have to watch out for is that October 1st deadline. So if you go past that, it might get a little bit trickier for your withdrawal. So for any very specific personal situations, we do recommend chatting with an accountant, a tax professional, maybe a financial planner that can help you out and make sure that you don't get in trouble or anything like that. And question about, are you covered by FDIC? So good question. We technically are not because we're a Canadian company. So FDIC actually refers to Federal Deposit Insurance Corporation. That's in the US. And that's how US bank accounts are insured if the company goes bankrupt. Questrade, since we're a Canadian company, we don't have US insurance. We're actually regulated by IROC, the Investment Industry Regulatory Organization of Canada, as well as a few other organizations. And we have a type of insurance called CIPF, which is a little different but works similarly. And that's the Canadian Investor Protection Fund. What that protects is every single Questrade account is protected up to $1 million by CIPF if Questrade were to ever go bankrupt or go under. That means even if we disappear tomorrow, your money is yours. Your stocks, your bonds, whatever you buy, that is yours and will remain yours. And on top of the $1 million, Questrade also has an additional $10 million in private insurance for all accounts as well. So your combined coverage is $11 million. Pretty good chunk. If you've got more than that, that's a nice problem to have. And question about RESPs for a grandchild who's going to be moving to Canada in 4 years. This is a bit of a tricky question. If the grandchild has a SIN number, if the grandchild is considered a Canadian resident, you can open the account. However, if they're living abroad and they're not considered a Canadian resident, they don't have a SIN number yet, unfortunately, you cannot open that RESP. You might have to wait. So it's a little bit of a unique circumstance. It all depends on the residency and the tax status. Got a good question about someone who's potentially worried about opening an account online because of the lack of face-to-face communication. And we get it. If you're used to dealing with the bank, if you're used to walking into a branch and sitting down with an advisor, opening and investing an account online can be terrifying. The good news is we always have real people for you to talk to that are here in Canada and spread out on chat and on live calls. So you can reach us from Monday to Friday, 8 a.m. to 8 p.m. On live chat calls or through email. And you are able to talk to a real person. If you happen to be here in the GTA, in the Toronto area, we do have our head office up in North York at Yonge and Finch. And you're happy to stop by when we're open. Always happy to chat and answer any questions you might have. Good question about the LIFs and the RIF accounts. So these locked-in retirement accounts. And let me just move our slide back. There we go. So in my LIF and RIF, will Questwealth look after the monthly payouts and hold back taxes for me? Good question. So it's a bit of a two-part answer. We will look after the monthly payouts. So in both a Questwealth and in a self-directed account, we take care of the withdrawals and the mandatory monthly payments that you have to make or yearly, however you choose to get those payments. Holding back taxes, however, we do not. So we only hold back taxes if you withdraw more than the minimum amount. So in a LIF and a RIF, if you take the minimum, it still counts against your taxable income, but Questrade's not going to tax extra on top of that. So it's up to you. It's your responsibility to potentially set aside some of that money for tax time. And it's a really good idea to talk to a tax planner or a retirement planner. If you take above the minimum, however, we do withhold something called a withholding tax. This withholding tax is sometimes enough to cover the taxes. It sometimes isn't. It all depends on your own personal tax situation. So if you've got zero income, it might be very different compared to if you're still working in retirement and maybe you make 60, 80K or something like that. So sorry to kind of jump out of the answer there. It depends. We do take care of the payments for you, but we don't withhold the taxes. So question about selling put options in a TFSA. So quick options one again. Promise I won't spend too much time on this. So can I sell a put option in a TFSA if I don't own the stock, but I have the cash in the account in case the shares are assigned? So this is sometimes called a cash secured put. Unfortunately, in registered accounts, it's not available. The reason being is it's more of a CRA regulation. When you're selling a put, that's technically borrowing money because you're theoretically creating that contract out of thin air and creating that liability. So even if you have the share set aside, you unfortunately cannot do cash secured puts in a TFSA account. That's only in a margin account. And question about, does Questrade withhold taxes on RSP withdrawals? We do. So when you make a withdrawal out of your RSP, if you withdraw while it's still an RSP, so we're not talking about a RIF in retirement, this is still an RSP account and you need the money for some reason. You can't wait till retirement. We do withhold taxes and there are different withholding tiers available as well. If you're curious, if you have questions about that, I can get one of my colleagues to drop some links in the chat. But if you also head to our Questrade website and go to the learning section, there's a couple of fantastic articles about RSPs that explain exactly how much tax we withhold. So generally, it also depends on which province you live in. If you live in Quebec versus the rest of Canada, it's different. So we do withhold taxes, but it depends on how much you withdraw and where you live. And let's see, got a few more questions, then we're going to wrap up in about a minute here, just to be respectful of everybody's time. Question about day trading in a TFSA. This comes up every couple of webinars and happy to answer it to the best of my abilities. That being said, I'm not an accountant. I'm not your advisor. So please take my answer with a grain of salt. Question from Jaspreet. If I do 5 to 6 trades in a TFSA in a month, does that count as day trading? The answer is we don't know. That is up to the CRA. The CRA has not published any guidelines on X amount of trades, or you have to hold something for X amount of time for a reason. If the CRA came out with rules for the TFSA, everybody would go right up to the rules and not one trade more. So it's a bit of an arbitrary decision by the CRA on what counts as day trading or running a business in your TFSA. They really look at a number of different factors, what your employment is, if you work in finance, if you have a repeated history of making lots of trades, if you're trading in more advanced derivatives. So a bit of a complicated non-answer in that there's no real definition of day trading by the CRA. What the difference between day trading and investing is, that's a line that you're going to have to determine on your own, unfortunately, since there has been no guidance released for us. So as long as you don't go crazy and don't go overboard, generally that's fine, but it is up to the CRA. And we'll do one more, 2 more, because I got a quick one. Can I add a beneficiary to my margin account? Unfortunately, no. So margin accounts, since they're non-registered, you cannot add a legally named beneficiary. If you have a margin account and God forbid something happens to you, you pass away or something, the best way to take care of that is through your will. So talk to an estate planner, talk to a lawyer to take care of that. For RRSPs, TFSAs, and other registered accounts, you do have the option of naming a beneficiary, or in the case of a TFSA, it's also a successor annuitant as well who takes over the account. So with registered accounts, very important to name those beneficiaries, in case anything happens to you. Margin accounts, make sure your will's set up. We can't really give any advice other than that. Maybe we'll cover a quick, simple one. So any fees or charges for buying shares at Questrade. So for those of you new in the audience that aren't familiar with us, one bit of great news is ETFs, or exchange traded funds, are completely free to buy. When you sell, it's between $4.95 and $9.95 per transaction. Let me quickly pop open our website and show you guys where you can find this yourselves. If you just open questrade.com, go to pricing, and whether you're interested in self-directed or active trader Questwealth Portfolios pricing, it's all here for you. So stocks, they're 1 cent a share, between $4.95 and $9.95 for both buys and sells. ETFs are free to buy, but then you pay the stock commission when you're selling. And then options are $9.95 plus $1 per contract. If you're more of an active trader and you trade a lot, we do have active trader pricing that will bring that down quite a bit. So if you're curious, please take a look at our website or contact us for more info, and we're definitely happy to go through the ins and outs of that. With that, I'm happy to finish off our presentation today. Thank you so much to everybody in the audience who has submitted their questions, their polls, and who's participated. Greatly appreciate having you all here today, and I hope everybody was able to learn a few things. If you guys do have any feedback, questions, concerns, there will be a post-webinar survey that appears in your browser at the end of the webinar. We'd love to hear what you have to say, and looking forward to seeing you here on the next one. Thank you so much again, everybody, and have a great rest of your Wednesday. Take care.